Hey everybody, we're ready for another safe investing update. Interest rates are continuing to go up, and we've got a Fed meeting coming up here in about a week. So lots to talk about. The reality is this is last month's interest rates. The 2-year was at 3.25. The 10-year was at 2.8. We were inverted. Okay. Well, now we're even more inverted. The 2-year is at 3.7. And the 10 years at 3.4. So we're seeing interest rates continue to rise. We're seeing the Fed's meetings coming out and saying that they're going to continue raising interest rates. So as long as we're seeing these inflation numbers, watch my inflation video. As long as we're seeing these inflation numbers, they're going to keep pushing. The market keeps pushing back. Inversion is continuing. It's a little wacky out there. So safe investing, we've got to figure out what works. We continue to see these rising interest rates. Bonds are not going to work. Okay. Realistically, is it nice to be able to lock into a 4 or 5% 30-year bond? Well, do you need your money? And when you need your money, what are interest rates going to look like? And that's the question. If you just want the interest off of there and you have no need for your money, bonds can still be a viable, safe investment, but it has to be for people that do not need the principal of their money, that can sit back and hold on to that investment for the long term. That's the concept of buying a bond. It's like a really long-term CD. Think about it like that. Okay? If you don't need your money, fine, not a problem. You can live off the interest and you don't need to sell that bond. I don't have a problem with individual bonds. Please don't buy those bond mutual funds. They don't make any sense. They're not really considered a safe investment, as most of you are finding out, because you're losing money every time interest rates rise. So interest rates out there right now on bonds, you're seeing the AAA, the 20 plus years, you're looking over 4.5%. That's what you should expect to get if you go out and buy an individual bond today. You go down to AA and AAA, or sorry, AA and single A, you can get over 5% on the 30-year bonds. Okay, the single A's, you can even get a 10-year paying about 5% right now. So not too bad. Again, if you don't need your money for 10 years and you just want a safe place to earn some interest, I don't really have a problem as long as you're in the A range. Triple B's right now, especially with interest rates rising, if we continue to hold interest rates at a higher rate, these triple B's, you're going to see a lot of them starting to fall into junk bonds. And just that demotion into junk bonds, you're going to lose a lot of value. So please be very careful when we talk about buying individual bonds. Stay in the A range. If you want something that is genuinely safe, you can stick with the triple A's and double A's. Single A's are going to teeter. If they get downgraded to triple B, then they're going to get a lower valuation going forward. Okay, remember, as interest rates rise, the value of bonds goes down. So if interest rates continue to rise, then we have to be careful about needing this money. So not a good solution if you're looking for safe investments for those required distributions or any of that type of stuff. The next side of this is fixed stuff out there. Okay, so fixed annuities, which are multi-year guarantee annuities. They are literally CDs from insurance companies. There's nothing to be afraid of. You hear the word annuity and some people have a knee-jerk reaction to it. This type of annuity, you're handing money to an insurance company. They're agreeing to pay you a fixed interest rate in return. And we don't need to be afraid of this. There's no fees, just like CDs at banks. There's no fees. How are they making money? Well, they're investing it and hopefully making a little more than they have to pay you. That's the reality of how this business works. Okay. The difference from a CD is simple. They pay compound interest. Okay. Tax deferred compound interest. So all the money stays in the account. It continues to earn on top of earnings. You can choose to pull money out. Another difference. You have 10% access to this money. That helps quite a bit. Okay, so 10% access means you don't have to get pushed into these 1-year CDs that pay very little interest. You can move out to the 3, 5, 7, 10 years. Okay, and right now the sweet spot's usually in the 5-year. but you can get some great 3 years out there. Every once in a while you'll see the 3 years over 4%. So you can see 4.2 is what I found, but they change all the time. Okay, so don't call, I need a speed up, whatever the heck that company is. It's going to change every time. So the day you're ready to invest money, we go through, look at the market, we find which one has the best interest rates at this point. Anybody in the A range, no problem. Even in the B plus range, don't really have any worries of that. You've got the state insurance fund guarantees on that that mirror FDIC insurance, and through history, all the regulatory stuff they have to go through, they have to get reinsurance, all that type of stuff. This is as safe gets. Okay, multi-year guarantee annuities are as safe gets. So great interest rates, no risk, and you have access to 10% of the money. So if you're looking for safe investments for maybe an IRA where you're going to have required distributions, you need to functionally be able to pull money every year. These things are wonderful. There's nothing wrong with these things, okay? The only problem with them is they're a stagnant flat interest rate. So if we continue up and up and up and up, then that stagnant flat interest rate is not as efficient, okay? Even though we haven't seen interest rates like that in the fours for a long time, it sounds good, but I don't know. They're better than bonds, I can tell you that. Interest rates continue higher, you don't actually lose money. If you're in a bond, you actually lose money, okay? So no risk, no fees, 4.5% on a 5-year, pretty darn good interest rates out there right now. So if you want more flexibility in the way that you're earning, okay, if you don't want to be stagnant and worried about interest rates continuing upward and being in a less efficient safe investment vehicle, then fixed indexed annuities are really the solution for that. So what's normal in all fixed indexed annuities? Well, first of all, you're going to have many different ways to earn interest, and you can choose how to earn interest each year. So you can change from an indexed interest rate, so indexed to the stock market, which I'll show you in a second. You can switch that to, say, a fixed interest rate. You could go from a low volatility stock index to a full S&P 500 index. They can change the math on how you earn interest. So you have a lot of flexibility on the ways you can earn interest in one investment, and you're allowed to change how you earn interest. So that's really wonderful when it comes to planning out how to utilize your safe investments over retirement, especially for required distributions. Okay, so these are the tools that are used in IRAs for a safe place to pull that required distribution from. Because remember, the key is never pull from losses. You have to have a plan. You have to have a place to pull from when the market's not doing well. Okay, so these give you 10% access. These give you 100% access if you happen to go into long-term care. Most of the companies do. Okay, so if you are in this safe investment and you happen to go into a long-term care facility, they open up 100% access for you. Death benefit, if you pass away, 100% goes to your heirs. No questions asked. Boom, beneficiaries listed, the creditor and lawsuit protected, goes straight to those heirs. And there's no fees in these, and there's no risk in these. Okay, by regulation, you're not allowed to lose money in these things. So what's new? There's a few new things going on in this market because the demand is so much bigger out there, and everybody's competing for the Schwabs and Fidelities and all those big boys that are trying to figure out how to put this into their portfolios. So the first thing we have to know about is guaranteed interest rates. Anybody that's had a fixed indexed annuity before knows that the insurance company can change the interest rates through the years in your contract. So your offerings can change every year. Okay, and that's why we got to work with companies that we trust that have a good track record of keeping good interest rates in their investments. Okay, but now that's changed. All these companies are starting to come out with these guaranteed interest rates. There's a 5-year product. I've never seen a 5-year product that has good interest rates in it, and they're guaranteed for all 5 years. And there's even a 30-year, or sorry, not a 30-year, a 10-year one. Which strangely, I actually recommend for a lot of people the 10-year over the 5-year. I know that sounds bizarre because, well, I only have to commit for 5 years. Well, that's true, but what happens in 5 years if interest rates are way back down? What if we keep pushing and pushing and pushing and we break it and everything falls apart again? And then we're back down to zero interest rates. Okay. So we need to think about these things when it comes to having safe investments in a portfolio and having guaranteed indexing, not fixed interest rates. Remember how flexible this is. Guaranteed indexing rates for 10 years is pretty fantastic. Okay. So even especially when they're interest rates like this, 135% of the S&P's multi-asset index. Fidelity has a multi-asset index. You get 145% of that. If you want some of the socially responsible indexing without any of the risk, BlackRock has an ESG fund and they mirror that and say, we'll pay you 135% of whatever that stock index does each year on your anniversary. If it's up, you get paid. If it's down, you get paid nothing, but you don't lose anything. If you want to throw it into a fixed rate, 1 year choice, 3.5%. Show me anywhere you can get 3.5% for 1 year. You can't. So the nice thing in this is the flexibility, and we don't have to worry about the insurance company changing the interest rates. That's fantastic. It gives me all the confidence in the world that this is probably the best safe investment out there. And to have it for a 10-year guaranteed interest rate, to me, is still a fantastic idea. Then the other cool thing that's happening out there is building these fixed indexed annuities that are really more geared towards growth. Okay, so some people don't like that, you know, your average earnings are going to be, the industry is supposed to say 3 to 6. We back test these guarantee rates, and those back testing is now real because they're guaranteed rates. They can't change them. So now we're looking at 6, 7, 8%. Well, this new development is really intriguing, and it's all because of technical options trading that goes on behind the scenes. Okay, this is how these insurance companies protect themselves. The regulators have made it very clear. They clarified this for this insurance company that created this fixed indexed annuity. Your principal cannot be at risk. Okay, so your future earnings can be at risk. You can choose to put them at risk in this new product. And what's cool about that is if you choose to put it at risk, you will get paid more. So you can choose to put 2.5% at risk of your earnings. Okay, and they'll pay you 130% of whatever that stock index does. You can choose to put 5% of your earnings at risk, and you can get 160% on up to 200% of whatever the stock index does. And it's because you're willing to accept some of that risk on the downside. If the market goes down, you can lose some of your earnings, but never principal. So if you want something that's more growth oriented, holy cow, does this have firepower. You should see the last 20 years. The last 20 years, even through 9/11, through 2008's crash, all that stuff, this thing outperformed anything out there. It's incredible how well this thing has done. And it's really creative the way they've created this, and it makes sense. We've talked to the actuaries, we've talked to everybody involved in this, the investing department, on how they're doing and structuring these options that really make this work. Always happy to talk about that stuff because it's the geeky stuff behind the scenes that we really work hard on. So in terms of safe investments, if you kind of worry about the growth structure in some of these safe investments, or maybe you're just super conservative, but you're worried by not having enough money in the stock market, you're not going to keep up with inflation. This thing has the firepower to really give you a boost in the portfolio when you have a boring, safe investment portfolio, especially if you're in fixed interest rates. Mixing this in when you're using the fixed interest rates really will help you keep up with inflation, keep up. If the market goes and takes off, this will keep up with it. Okay, so great opportunities out there for safe investments right now. We haven't seen safe investments like this ever, as far as I'm concerned. There never were safe investments like this before. I've been around these since they began back in the 80s and 90s. We've seen them develop. The reality is this is the best stuff that we've ever seen out there. So thanks again for joining us. Let us know if we can help in any way. If you want to discuss how any of these safe investments relate to you and your portfolio and what would be right for you, we're available via Zoom nationwide. We're available certainly in person in Scottsdale, Arizona, or Prescott, Arizona. I'm always happy to get together with anybody and chat about anything. If you like our videos, please make sure you click on some buttons and tell us you like them. Submit some questions. If you want me to talk about any topics out there, I am always happy to create videos and get them out for everybody. Thanks again. We'll see you next week.